Hey guys, Mike here from Replic Ones. Let's talk about the safety equipment necessary to trade stock options. First important, harness, right? You're gonna get hit. You're gonna get hit hard. Back protector. Alright, I don't know if it shows my ass or my back, but you can see it right here. Kneecaps. Knee protectors. Hardcore, because you're gonna bounce. And what else? Oh yeah, neck brace, helmet, and of course safety jacket. Very important. And since it's badass cold outside, plenty of layers. All right, I think we're good to go. Hey guys, let's go for a ride. Let's talk about options. Let's turn this thing on. All right, off we go. All right, let's do this. All right. Whoa. Watch it. Oh shit, forgot the gate. Oh, that's so embarrassing. Oh. Okay. All right, let's go for it. Okay. Nice day, huh? Woo! Gotta wet the puddles. Oh. Yeah, boy.
Okay, welcome everybody. I got a lot of emails over the last few days when I posted my P&L from my options trading over the last year, and people were asking me, so what type of options are you trading? What strategies? Should I trade options? How much money do I need to trade options? Is options trading difficult? All that kind of stuff. And let's make a video and cover some of the basic questions. First question. Are options difficult to trade? Do I need to train and practice and to learn, study for 5 years, 10 years before I'm able to actually make any money with trading options? And my answer to that is absolutely not. The way I learned how to trade options was from old floor traders back in the days. Now, I'm not that old, okay? But I had the privilege of learning from people who used to work on the floor, who had that type of experience, who learned just by looking at the board right in front of them, without a Black-Scholes calculator, without a computer, and were able to, just by looking, assess their risk potential and their probability of making 1 cent or more within a given amount of time. And that has been lost, I feel, because a lot of people make trading options way too complicated, and they're primarily focused on strategies. I think the biggest mistake that people make when they just get into options is to focus way too much on complicated spreads. And I think that started way back with Larry McMillan, who wrote basically the book on trading options. He wrote Options as a Strategic Investment. I think it was back in the 80s, if I'm not mistaken. And since about that time, people have been thinking in terms of strategies, complicated spreads, right? Like bull call spreads, bull put spreads, bear put spreads, bear call spreads, call ratio back spreads, whatever. Essentially, there are just two types of spreads. You can sell a spread or you can buy a spread. That's it. You can buy a spread, you can sell a spread. And if you know how to do that, you can compile any type of option strategy that's out there. It doesn't matter. You can put together an iron condor or you can sell a butterfly. It doesn't matter what it is, because once you know how to put together a basic spread and to calculate your risk and to evaluate your probability of making any money with it and how much, in what amount of time, at which price point, all these kind of things. Once you know that, then you can do whatever you want. You can put together any type of option strategy that's out there, and it'll be easy for you because you'll actually understand how they function internally. And I think that basic knowledge has been lost because people learn it the wrong way. I teach it the right way. I teach it the way old floor traders used to learn it. That doesn't mean I don't take advantage of modern tools. I'm a quant trader after all. But if you learn something the proper way, then the more advanced topics are much easier to grasp. And quite honestly, you don't have to learn advanced strategies in order to be profitable with trading options. Some people trade vertical spreads all day in and all day out, and they're just doing fine. So people have to abandon the idea that it takes a PhD level experience in order to be profitable trading options. Next question. Do I need a lot of money in order to trade options? Well, I'm not going to BS you. Of course, more money is always better. But I've seen people trade options with accounts as small as $5,000. So no, you don't need a lot of money. But more money, of course, more account principal affords you buying power. And more buying power allows you to do things that you can't do with a very small trading account. So no, you don't need it. But of course, it's always better. That said, as I mentioned before, I've seen people trade accounts as small as $5,000, sometimes even a little bit smaller. It's just going to take a little bit more time to work your way up. I mean, that's the whole idea. You can't expect to have a $5,000 account and make $5,000 or $10,000 a month. Right? That's just not going to happen. I mean, you would have to be not just extremely good, you would also have to be extremely lucky at the same time. And those two factors, those rarely coincide. So you have to be realistic about it. Next question. What do you like most about trading options? Well, where do I start? What I like most of all is that I can clearly define my risk. So if I buy a spread or sell a spread, same difference, I can clearly define my risk. So let's say my risk on a spread is $1.50. That's $150 because you always control 100 shares for the uninitiated. But let's say it's $1.50. That's the most I can lose. Of course, there are ways of losing a lot more with trading options. You could sell a naked option, put or call, and lose a lot of money if the market moves against you. So that's very much possible, but that's not really what we do, ever. So when I trade a spread and I say my defined risk is $150, $1.50, on this particular option, then that's all I can lose. And I really, really, really like that. The second thing I really like about options is I don't have to worry about placing a stop. Nobody in their right mind uses stops when trading options. Why? Because you define your risk ahead of time. But there's an implicit advantage of doing that, which might not be clear if you're not an option trader. If you're a systemic trader, what do you do when you, let's say, buy a futures contract or a forex contract or even just buy stock? Well, you place your stop somewhere because you're not insane. You want to protect your portfolio, and so at some point you know that, well, this trade is going to go sideways, and so you place a stop somewhere. So let's say you have a $100 stock. Let's call it Evil Corp, and it's trading at $100, and you buy that stock. Let's say you bought 100 shares of Evil Corp. So $100 by 100, that's $10,000. But you don't want to lose more than $1,000 on this trade. So what do you do? Well, you set a stop at $90. Why? Well, because for each share you will have lost $10, right? You bought 100 of those shares, so 10 by 100 equals 1,000. That's the max loss you want to endure. Great, okay, so we bought Evil Corp at 100. We have a stop loss at $90. Now, if you've been trading for more than a week, then you've learned that nothing in finance ever moves in a straight line, especially in the stock market, or in crypto, or in forex, or in bonds, or in the futures. Things move sideways quite a bit, and so it's quite possible that right after you bought Evil Corp, it might just drop to 95, and then to 90, maybe even 88, and then snap right back to 100 within a week or so, and go to 110 or 120. That happens quite a bit. And so if you set a stop, well, what happens? Well, you bought the stock at 100, you get stopped out at 90, you lost your $1,000, and you're out of the game. Now, imagine another scenario. Imagine a scenario where you didn't buy the stock, as opposed to buying 100 shares. Maybe you just bought an option for a few $100s, right? You control the same amount of shares, you control 100 shares. You bought the $100 option, but instead of spending $10,000 in order to purchase 100 shares of Evil Corp, you just bought yourself an option for, let's say, $400. Now, before you jump down my throat, no, I would never buy a naked option for a trade like that.
That's an awesome
But just to keep things simple for everyone, let's assume I just bought a car for $400. My max risk is and will always be $400 because that's the most I can lose. It doesn't matter if Evil Corp drops to 80, 70, 50, 20, or even 0. The most I can ever lose is the debit I paid for this particular option. I paid $400. That's the most I can lose, period. But the main advantage here is that Evil Corp could, for example, drop to 70 or even 80 and then bounce right back and go back to $100, or even maybe go to 105 or 110 or 150. We've seen pretty big moves over the last few years, so the more volatility, the higher the risk. Now, if I decided to purchase an option instead of buying the underlying stock, then I have the advantage of being fairly insulated from large price swings. Now, that doesn't mean I'm insulated from losing my money if my option expires worthless, but I'm insulated from big price swings. So if they're momentary price swings, I really don't care too much about it, because I know as long as I hold this option, there's still a chance that things will snap back, especially if there's a lot of volatility in the market. And that makes things a lot easier for me, because now I don't have to really worry about placing a stop, because I know it doesn't matter if Evil Corp goes from 100 to 80, 70 and then snaps right back, because maybe there's an earnings support, who knows, right? Or some kind of, or maybe there's some exogenous event that causes the entire market to move in a big way. So these things happen all the time, but I have a lot more leeway as opposed to trading with a stop, where I know that at some point, if that price point is reached, well, I'm SOL. I basically lose all my money because I'm getting stopped out, I'm back in cash, and I have absorbed the loss. With options, I don't have to worry about that kind of stuff. My risk is priced in, and that's the most I can use. Oh, wait, hold on. Right here, watch me bounce. 3, 2, 1, and here we There was this tiny bump, I don't know, there's one rock and it took me out. And I don't think you can see it in the video, but there are actually some blackberry bushes a little bit further to the left, and I'm glad I didn't end up in there, because that would have been really painful. Anyway, but just coming back to options, I think that's clear, right? If you're holding an option, your risk is clearly defined, and you also are able to withstand and sit through big price swings. And I think that's a major advantage. And the most obvious thing I like about trading options is that your capital requirements are much smaller. So as opposed to having to tie up $10,000 worth of your assets in order to buy Evil Corp, the stock, you can now just buy an option for a few $100 and Bob's your uncle. So that is a major advantage. You're able to control 100 shares of that stock without having to lay out a huge amount of capital. And that in turn affords me a lot of flexibility, because maybe I can hedge myself, or I can take on more trades in order to be more diversified. Whatever it is, less capital exposure, less money I can lose potentially if the stock drops to zero, which admittedly doesn't happen very often, but we've seen big moves over the last few years. Watch those cows here on the right. The first few times I was riding by, it kind of freaked them out, but I think they're used to me now. The thing is, this thing is electric, right? And it doesn't make a lot of noise, so you just fly by those cows and they're like, whoa, what was that? You know, because they don't hear it coming. Here up front you see my wife, actually. She's riding as well. I taught her a few months ago and she's doing really well. I'm really proud of her. We both started riding last year. I was the first, but I actually did buy 2 of them right away, because I know my wife, and although she was a little bit skittish in the beginning, I knew she would do just fine, and look at her now. Looking good there on the unicycle. It's a hell of a lot of fun. It really feels like flying, especially like, yeah, right there, right? You just kind of lean forward and the thing just takes off. It's fun. you gotta be careful because, if you face plant on that thing at like 40, 50 kilometers an hour, right, 25, 30 miles an hour, whoa, yeah, it can be painful. I use the best equipment that you can find, but yeah, obviously at that speed doesn't make that much more of a difference. As the bikers always say, dress for the slide, not the ride. That's exactly right. Okay, next question. How many trades do you usually take per week or month? Oh boy. Look, I don't usually hold myself to a particular schedule. Trading options, it's something that's really seasonal and it's very market phase dependent. So as a rough guide, I usually hold like between 5 to 10 campaigns concurrently open, and I might trade as many as 10 to 15 at the same time, but it really varies. It also depends on how the market is behaving, because when the market is very volatile, you need to be extremely selective in your entries. And when I have reached a level of risk that I'm comfortable with, right, when I've reached that threshold that I don't want to breach, then I will reduce either position sizing, take smaller positions maybe, or I will just not trade or wait for a position to close. What I don't want to do is have 20, 25, 30 trades open at the same time. A lot of people actually trade like that, and I've never traded this way. I've tried it when I was really, really inexperienced, and I had this laundry list of trades open, and I had a hard time maintaining them. So I think the old expression applies, quality over quantity. So it's not really a matter of how many trades do you take per month, it's how many good trades do you take. And I think my P&L speaks for itself so far. But of course, losses can always happen, and often they can be correlated. So you want to be careful, especially in this highly volatile market right now. Next question. How do I get started with trading options? Okay, I recommend that you spend a few months paper trading along with us to make sure you're familiar with, first up, your trading platform, of course, and you also understand how to open and close a trade. That's kind of essential. You should only start trading options using real money when you are confident in your abilities to participate. What I would definitely recommend is that you start watching the courses I've posted in the Red Brick Ones Academy. Specifically, I recommend you start with Options 101 and Options 201. Those are really essential, and they will teach you a lot. All right, that's probably all the questions that I'd like to cover today. Thanks for riding along here with me. I'm going to cruise a little bit more and enjoy the rest of my day, and I recommend you do the same. Oh, I almost forgot. While I have your attention, I would be amiss to not mention the kick-ass end-of-year super sale that we're launching in December. Normally, Red Book Ones Unlimited runs for $149 per month, and you'll be able to grab it for $597 for 6-month subscription or $997 for an entire year. That's a great offer, and if you're interested, you know where to find me. If you have any further questions, don't hesitate to send me an email at mike@redbookones.com. That's mike@redbookones.com, and I usually respond within 1 business day. That wraps it up for me. I'm going to keep cruising for a little bit longer and enjoy the day, and I recommend you do the same. Okay, see you next time.